Hello everyone. My name is Kamal Manocha. I represent PMS AIF World platform. We have been doing, weekly webinars every Friday and trying to learn and educate ourselves from the wisdom of various portfolio managers, especially who have been doing good work. And in that regards, today we have Mr. Neil Bahal from Negen Capital. Actions speak louder than words. And in case of Negen Capital, rather than introducing the fund manager, I would talk about their performance numbers. Last 3 years, their performance has been 30% as a CAGR, but I'm giving broad numbers. Last 2 years, it is 60%. Obviously, last 2 and 3 years, everyone feels has been relatively an easier period, but these numbers are far bigger and kind of speak a lot about the underlying process of the performance. And that is what you want to understand today, which is what the topic is, which is special situations investing. So special situations investing is something which many other larger players also in the industry have been trying to do. Many have kind of got it wrong, many have got it right, but somebody who has actually been doing it religiously right month after month, and we have been watching it, is Mr. Neil Bahal, and that is what we want to understand from him, that how he has been doing it. Because for any investor to kind of base his trust, it is important to actually understand what are the learnings, how has this process evolved. Basically, the basic definition of special situation investing is something that all of us understand. However, we want to learn more from the practical examples of how risk and rewards kind of play hand in hand when a special situations investment decisions are taken by a portfolio manager. And that is the practical, I would say, reality that we want to understand in this webinar. And that is where the format is that first half of this webinar we'll be covering a little presentation which Neil has prepared with regards to various case studies on various businesses, and followed by that we'll do Q&A. Any of you, all of you, who may have questions, you're most welcome to type your questions in the chat box. We'll take them all post the presentation is over. Formal welcome to all of you to this Friday webinar. Over to you, Neil. The floor is yours and you can begin with your presentation.
Thank you, Kamalji, for having me over. It's always a pleasure to interact with you. I think the last chat that we did was maybe a year ago. That was our first chat, so it's a good to kind of come back on your platform. And hi everyone. I see there are about 172 people and increasing. So thank you for joining us. I know the weekend is fast approaching, so I'm not going to make it very boring. I know we've all gone through a stressful week, so we'll just keep it very up to the point as always, and hopefully kind of showcase to you how special situations really work. Is more of an educational standpoint more than anything else. Thank you for joining us. So shall I start, Kamalji?
Yes, absolutely.
Okay. So today's topic, guys, is about special situations, but we thought we'll just not talk about it in a very generic sense. We will talk about it with some examples, so that you get a good understanding of how a flow of special situation really works. Because I can talk about names and you can look at it. Better than that is always to understand why I'm saying a name and why something does work in this special situation, standpoint. So it's just a short presentation. We'll not keep it very long, very boring. We're going to keep it up to the point. And as Kamalji said, we can do a Q&A afterwards also. So, what we want to do, all of us, we have different styles. Somebody wants to do speculation, somebody wants to do momentum, somebody wants to do coffee can, and somebody wants to do value investing, and somebody like us wants to do special situation. Everybody has their different kind of investing point of view. But if anyone has to describe investing, what is the function or what is the need? Like, what are you trying to achieve? So in its purest form, if I have to say, we have to buy a good business. Everything should be good. Cash flow should be good. Its quality, brand, moat, all those things. So good business. But at the same time, a good business can become a good stock. There are different things. Good business and good stock. A good business can become a good stock only if you buy it below fair value. You're not going to make a multi-bagger kind of return, or you're not going to create alpha buying something like an Asian Paints. Yeah, if you buy Asian Paints in the deep bear market, good. We can make good amount of money. But in today's market, paying something like a 60, 70 times for a company like that, there's just no chance that you can make a more than 14 to 15% kind of CAGR. So I've kind of made a presentation where I'm trying to outline to you what we want to do in terms of creating alpha. The entire thesis of doing special situation is creating alpha, and it also helps us in other ways. Just get on to this. So let's kind of start from the beginning. Okay, we have, like how Buffett said, that he has won the ovarian lottery. He was at the right place at the right time. I also believe Indian investors who understand what exactly is happening in India today have also kind of won an ovarian lottery. The next maybe 10, 20, 30, maybe even 40, 50 years in India are going to be exceptional. We have a joke going on with a lot of our newsletter readers that, we are going to have a yacht party in 2050 where we all remain invested and we make so much money that we buy our own yachts. So the basic framework, the basic groundwork is already set in India. Like if you have to say something in Hindi, जिसमें जितना दम है वो उतना कर सकता है. अभी हमको कोई नहीं रोक सकता. We are absolutely the best place in the world currently. So the GDP is likely to grow 7 to 8% per year. Now, a rule of thumb is that when GDP can do 7 to 8% in a year, good quality businesses or decent businesses can grow double of that. So 14 to 15 to 16% can be an average earnings growth that you can expect. Now, when you have this kind of underlying, situation which is so good, now you can only mess it up by doing weird things. So obviously we kind of strike out things like speculation and leverage and derivatives and too much concentration, all those things. But even if you do the wrong kind of investment, are you going to be happy to make just between 7 to 14 or 7 to 12 kind of percent CAGR? No, we want to create alpha. That's where all the wealth gets made. So if you do a simple value investing, it can lead to a lot of frustration because something that you're buying for cheap may remain cheap for a long period of time. The value may never get unlocked. But when we look at it from a different lens, things can be very different. So, there are some points over here also. Like as I already said, cheap can remain cheap for long periods of time. Like, the great investor R.K. Damani once said, धारावी होता है और कफ परेड होता है. So cheap may remain cheap. It's not going to be a good idea to just buy some company because it is cheap. And also you have to think in another way. Market is today knowing everything. Like, everybody has information on everything. If something is good, then why would it be cheap in the first place? So these are the kind of frustrating outcomes that can happen if you do simple value investing. Now let's look at it from a different lens. The same kind of scenario again, you have 7 to 8% growth in GDP. Good companies will grow 15%, let's assume. But now you have special situation which can give you significant CAGR. Now, if you see the father of special situation, as to say, Joel Greenblatt in the US, he did 50% CAGR over a period of 12 years. Now, this is post fees, and he did only focused on special situations. Now, if you go, he's never gone and bought these expensive stocks. He's always kind of figured out where the value is going to get unlocked. So, in my opinion, special situations are the difference maker in a portfolio. The real reason that we want to do special situations, actually the second point, the reason why we want to do special situations, because we want to avoid the value traps. Now, there may be a company which has just looked cheap, but if there is no special situation attached to it, it will always remain cheap. I'll give you an example. We are going to touch up on that example again, but I'll give you an example nevertheless right now. Maybe just go on the slide and come back. This DFM Foods. Now, in 2019, there's a US based private equity fund called Advent. They did a they did a buyout and an open offer at 249 rupees per share. And then, as you all know, that COVID came and created havoc in the world. And what was a pretty nice story went through a lot of roadblocks. The entire snacks industry was suffering because normally school children are the people who normally eat all these things more. So when the schools were shut, the colleges were shut, their business went through a temporary down cycle. So something like a DFM, which had, after the open offer, it went up to 400, and then because of COVID came down to 200. So it became cheap. Okay, it became cheap, and there would have been a lot of value investors who would have thought, okay, this is cheap, let me buy it. But at that point of time, when it was 200, it was going nowhere. It was a classic value trap. That's what we want to avoid. And then the owner, which was Advent, they said, let's just delist. So as soon as the event comes, that word delist comes into the picture, the stock went from 200 to 400 within a span of 3 to 4 months. Now, what is the conclusion that we are trying to say over here? The conclusion is that value investing is good, but value investing with a trigger of special situation can create miracles. So if there was no delisting announced in DFM till today, I could have guaranteed you that the stock would have remained at 200. The prospects of the business did not change as much, but the whole situation where the delisting got announced, that forced the market to kind of value the business appropriately. So this is it's a very clean example of what delisting can do and what special situation can do for your portfolio. So as an investor, when the price was 200, the delisting got announced, even if you got at 210 or 20 or 30 or 40, you're making a huge amount of money, but you're buying when there's a trigger, and that's what you want to do. Let me just go back. Wait, I'll just show you the chart. I think we have a chart here. No, this is something else. Yeah, so we just covered this. So and it's not something which has happened today, which I've come to realize and nobody else knows. It's not like that. It's actually a very well discovered way of investing. But interestingly, in India, nobody likes to do this, or nobody understands it, or I don't know why, but everybody, at least in the fund management industry, I'm not giving a ballpark number, but I know it for a fact, approximately 94% of all the money that comes into the Indian market goes into the same top 100, 200 kind of companies. Now, everybody is buying HDFC, Kotak, Pidilite, like Infosys, TCS, and so on. So there's a whole kind of a universe out there for people like you and I to benefit from. I think we are the only special situations fund in India. I think recently somebody pointed out to me that there are a couple of new ones, but we are still a big minority now. So there is a case study that was done in the US. There is actually a lot of data behind this. The case study was done, and it was a case study done. It was not a simple case study. It was a case study done over a period of 20 years. And what the case study simply said was that what would happen if we were to buy all of the special situations without exception. Don't use your mind, don't do judgment, don't do analysis, cuttlebutt, thinking, cash flows, good promoter, bad promoter, nothing. Okay, buy all of it, blanket, and hold it for a period of 3 years, because typically a special situation cycle is around 3 years. Even I've noticed, whenever we buy a stock, we keep it for 2 to 3 years at least. That's where the value discovery kind of plays out. So if you bought all of the special situation in the US over that 20-year period where this big university did the case study, the result was pretty amazing, I would say. That this portfolio of all special situations, which was held for 3 years and then recycled and got the next set of special situations, yielded a return of 20% CAGR versus a 10% CAGR for the S&P 500. And this is honestly a blind, you play Diwali time is here, so I can say things, you play Teen Patti or call it flush, you play blind. So this is like just a blind special situation kind of bet, and without even thinking or doing anything, you made a 20% kind of return, and that over a 20-year period. Now, even Warren Buffett in the last, I was seeing, I think, someone's interview today, and he said Warren Buffett over the last 20 years has made a 8% return. You kind of beaten Buffett. Of course, to be fair to Mr. Buffett, his portfolio is huge, and if he were to do again like what he was when he's a young guy, he would definitely do a 40-50% kind of CAGR. But you beaten Buffett, nevertheless, it's a good thing to kind of say. So if anybody wants to kind of get more in detail about this case study and more in detail about different situations that happen in the US, that Mr. Joel Greenblatt's books are a very good way to read it, and it's very simple book. The way we write the newsletter is simply written. There's nothing boring over there that may just put you to sleep. So I just thought it's a Friday, that it's going to be a little bit funny. So just simply put good plus cheap. But once you add the special situation trigger, that gives you that alpha that you need, because at the end of the day, the one thing that we are all after is alpha, because we all make money. It's not that we'll not make money. You just randomly buy any stock, not any stock, but a portfolio, let's say 20-30 stocks you buy, you'll make money, because India, as I put in the first slide, India itself is a very special story where nobody can stop us today. But how do you create that wealth for yourself? The wealth can only be made if you have this kind of a strategy that can create alpha. So always look to do value investing, and look to do value investing, attach it with special situation. Buy a cheap company when it is in the process of unlocking value. The unlocking of value could happen from delisting, as I just showed you earlier, from DFM, or it could happen from demerger. It could happen from something like a promoter changing. And there are other things, where people don't know about, but they're actually pretty good. Like there is something called a leap. Now, maybe we can do a webinar some other day, and I'll explain to you what's a leap. It's like an options contract, kind of like a warrants, but a listed warrant. So there is something called the HDFC Limited and the HDFC warrant. So when it listed, we made good amount of money in that. So there is something like that. Then there's something called a reverse merger, where what we are doing. People who are associated with us, at least on the PMS already, they would know that how we invested in the Ujjivan holding company, which gave us a 40% kind of an arbitrage opportunity. There's a reverse merger there. Then there is a rights issue where partly paid up shares are kind of also there. And also in the rights, if you have a good view on a company, you can oversubscribe to a rights issue, because lots of the retail investors, they don't understand what is rights and what is partly paid up and all those things. So when the rights issue comes, they never apply. So their share of rights which are unsubscribed for, you being an investor today, you can oversubscribe. So let's say you have an allotment, you are entitled for 100 shares for the number of shares you own, you are entitled for 100 rights shares, you can apply for 1000 shares. So all the other investors who have not applied, you get their shares. So now let's take for example Coastal Corporation. If I had done that, if I had oversubscribed for the rights, and the rights is at 225 while the share is at 340, so if I was entitled to 100 shares, and if I applied for, let's say, 1000 shares, and in the end I ended up getting, let's say, 100 extra shares, so instead of getting 100, now I got 200 shares. So I could just simply take that 100 shares and sell it at 340 because I got it at 225. So these are the kind of special situations that people don't know about. And it's kind of become my mission to, of course, from the fund, we want to do it, but also, keep doing these kind of webinars on such lovely platforms where I can keep talking about things, and you could, benefit from it, learn from it. We also have a YouTube channel. If you just go on YouTube and type Neil Bahal, Negen Capital, you can just join the YouTube channel. I'm thinking of doing a series where I'll do short videos and keep explaining with case studies on 2-minute, 3-minute videos. So you can join that as well. So yeah, the disclaimer, whatever we want to talk about in terms of actual stocks, please don't go thinking that I'll buy the stock. That is not the motive, because we have a lot of people who see what we do on a daily basis. I get scared to talk about stocks because you hear bad stories then from time to time, that I may also exit a company after saying here, but I may forget to tell you. And then, it's just not right to just kind of understand what I'm trying to say in terms of the process that I want to outline. Don't look at the stocks that we talk about. We already covered this. This was a beautiful delisting where a simple value trap unlocked the value, and an investor, even if he was late, even if you bought it instead of 200, if you bought at 220 or 240, you still made a huge amount of money within 3 months. So this is what the power of special situations are. It can turn a value trap into a value bet. And I think, not a lot of things are said about this, but the one true purpose of a special situation is that it helps you to avoid the value trap, because you're not investing in a company when the company is sleeping. You're investing in a company when the company itself is looking to unlock the value. So yeah, I hope I'm able to drive that point across. Now, this is a great example of a very, very good special situation that happened earlier this year. Company called Jackson Pal Pharma. Very, very sleepy company. Let me say downright average company. Nothing happening in the stock for multiple years. Company going nowhere and cheap. So a typical value trap. People think it's cheap, people buy and they forget, and the stock does nothing. It just actually keeps declining. Now, can you see the volume spike that happened in February, after the 8th of February and between March? This was the time where a new promoter came and announced an open offer for this company. Now, interestingly, the new promoter was not a normal person. The new promoter came from Fairfax, which is Prem Vatsa's company. Now, Fairfax is a global private equity kind of company which owns multiple investments. And this person who took over Jackson Pal Pharma is the person who left Fairfax, but he was the champion of Fairfax. The main guy in one of the main guys in Fairfax, who was credited with a huge number of turnarounds in his time in Fairfax. So this is his first innings where he's doing something for himself. So he comes and announces that open offer, and the stock is at around 180, 200, and it remained there for a good number of 15 to 20 days. 200, 210, 180, this kind of zone. And then he comes and says what his plan is. And people suddenly take notice. This is not a normal guy. This is a proper, let's say, a real stalwart, let's say, from the industry. And he has a plan. He has the money. And he comes and gives this entire growth plan. Suddenly, overnight, the DNA of this business changed. It is no more a sleeping company. Now it's a proper business with a new promoter, a lot of fire, and who wants to do big things. The stock, within a period of, I don't know, 6-8 months, has gone from 200 to nearly 400. Again, the stock doubled. And what has happened is nothing but value discovery. The earnings will come later probably, but this is just value discovery. The value trap got converted into a value bet. And this only happened because of special situation. That volume spike, the chart, the price going up, none of it would have happened unless and until the new promoter would have come in. So just a disclaimer again, we don't own Jackson Pal. I wanted to give a example of something which I don't own, so that there's no compliance issue over here. So I personally don't own. None of the people that I've spoken to own, nor does the PMS, nor the small case owns this. So the turn of events was open offer was followed by the boom in volume that you see here. Open offer and volume happened at the same time. Then the growth plans got unveiled. Then people realized that this guy is not a normal guy. He's a significant background is there. He's an ex-Fairfax champion, credited with very many big turnarounds. And that resulted into a huge re-rating. Stock from 180 rupees went to 400 within a period of months. So again, what I'm trying to kind of explain to you is understand the flow. Understand the flow of what we are trying to do. The DNA, okay, special situation, you have to focus on the DNA changing. If the DNA is changing from a sleepy company to a world beater profile, it cannot trade a 5 times earnings and 7 times earnings. It will get a industry peer valuation. So similar thing just happened into this Jackson Pearl Pharma. The valuation had to adjust, and anybody who was looking with a magnifying glass could have simply just added 2 plus 2. It was a very, very simple thing to buy. Of course, I'm saying this, but I was sleeping. I was probably asleep when this happened. I completely missed it. I should not have. But at the same time, we got a lot of things right too, so we should not feel bad for ourselves. But this is what we need to understand. Even if you get a few of these right in a given year, you will create alpha. I don't think our fund's performance over the last so many months and quarters and years is every time we are creating alpha. It's because I think, of course, the India story is great. Of course, I credit a lot of it to India, but I also credit to this way of investing. This kind of investing really works. A cheap company which remains cheap without special situation but becomes a great investment after some kind of a value unlocking goes on. So we as investors, we really need to keep track of this. And there's endless examples actually. I can keep talking again and again. I just had a CNBC interview. By chance, they were flashing CG Power. So CG Power is a great example. The stock was at 5 rupees, and he was about to enter NCLT. The previous promoter was completely pledged and not bothered, sitting in Netherlands. New promoter comes in, Murugapas, one of the finest business houses in India, turn around the business, come and talk publicly, saying that we have good growth plans. There'll be a lot of synergy. Stock goes from literally, okay, at 5 rupees it was not available what the growth plans were, but around 20 rupees the growth plans were pretty clearly available. That this is going to do very good, and overall the sector is doing good. So the stock just zoomed off within 1.5 years, zoomed off from 5 rupees to 250 rupees. Even if you count from 20 rupees to 250 rupees, still it's a great investment. So same thing with Green Panel. Green Panel was a demerger, not a promoter change, demerger, where the people who used to buy Green Panel used to not buy it for Green Panel. They were the actual shareholders of Green Ply, which is a much bigger plywood business. So when this company demerged, the erstwhile shareholders said, what is this small thing? I don't understand it. Is rubbish. It doesn't make profit. Let me just sell it. And the entire village, by village I mean the shareholders, the entire village of these people, they came, all these big funds, one by one, they came in the market and started hammering the share. From 60 rupees, the price fell to 30 rupees. And I mean, at 30 rupees, just the plant, okay, they had Asia's largest MDF plant. Just the plant was valued at 1,200, including the invested capital. It was 1,400 crores. They had invested in the business, and the market cap was just 300 crores at 30 rupees. Of course, you add the debt. Let's say the EV was something like 550, 600 crores. So you're getting a significant discount. And then as soon as the forced selling got over, the stock went from 30 rupees. You won't believe, it went from 30 rupees within 1.5 years, I guess, to 600, 20 bagger again. Same with KPIT. In the COVID low, it fell to 30 rupees. But forget the COVID low. When they demerged in 2019, it was 60 rupees. Nobody wanted it. It was just lying, almost a year at 60 rupees. And from 60 rupees post-COVID, went to 800. And Max was Max was our biggest holding back then in the PMS. I credit all these four for putting us on the map. So I like to talk about these four. But Max was an unbelievable example. At 47 rupees before, on the day of going X, basically on the day of delisting, while the demerger was going on, nobody wanted to touch. The new private equity fund KKR who bought at 80 rupees, that fell to 47 and nobody wanted to touch. And you won't believe, it demerged, it relisted back in 3 months. It delisted at 47 and relisted at 120. Almost a 3-bagger in 3 months. 3-bagger. It's not a joke. It was our largest position in the fund. It became a 3-bagger, and it didn't end there. It listed at 120, and within a few months, it was at 400. I think even right now it's 360. It's about 400 already. We sold, of course, but this is the kind of stuff we should be doing. The India opportunity is brilliant. 7-8% GDP growth. Companies will do 15%. I'm not saying any of these companies' earnings growth went ballistic. No, nothing fancy. Earnings growth was same, 15-20%, maybe 25% in some cases. What went ballistic was the valuation. But if you start an Asian Paint at a 70 times valuation, you're just taking one leg and cutting it off and say, I'll walk with one leg. It doesn't make any sense. You must have in your portfolio an ability to re-rate. Without re-rating, you cannot create alpha. It is impossible. That's why I will not say anyone's name, but most of the funds in India do a 10, 12, 13% CAGR over long term. They have not done more because of the style of investing they do. Lastly, I think I wanted to do 30 minutes. We've gone 33 minutes, but I promise this is the last one. Berkshire Hathaway, very, very interesting situation. This is probably the first big special situation that happened in the world. Buffett makes an offer at 14 rupees per share. The second event that happened, again, this is something not related, but they had a third partner called Rick Guerin. I don't know how to pronounce his surname. Let's say it's Guerin. Rick Guerin loses all his Berkshire shares at 40 rupees per share due to margin call. Like Buffett and Charlie Munger, he was not in the business of slow growth, compound properly. He wanted to get rich quick. So he said, I will borrow money, I'll take loans and I'll invest. And then there was a big crash and he had to liquidate his entire holding in Berkshire at $40. And you won't believe, he exited at $40 and today it trades at $4 lakh, $400,000, So on an unrelated note, India is on such a special wicket. Let's not even have a 2% chance of ruining our future by doing something silly like derivatives and borrowing money, investing, all those things. Just invest, buy Asian Paints for God's sake, but don't do this borrowed business, and don't borrow and invest basically. Anyway, so when Buffett came, it just changed the DNA completely of Berkshire Hathaway. It was a failing textile business, a classic, as I again kept saying again and again, the classic value trap. Failing textile business was turned around on his head. He entered into insurance, different kinds of insurance. He entered into chocolates with C's candies. He entered into furniture with Mrs. J. He entered into financial services. He just turned the entire business around all on his own, and it was all very visible. Okay, fine, you didn't understand at $14, you didn't know who Buffett was, but anybody who knew, paid attention would have known at $100, $200 that this guy has started doing dramatic things in the business. So, but had Buffett not come and taken over, this business would have failed. That $14 would have gone to zero. And all these value investors who say, okay, I buy things because it's cheap, they would have all lost money. So we have to make sure one thing, we are value investors also, but we are value investors in the form of special situations. This is the rule. I think it's a new rule of investing. So that's it, guys. I didn't want to keep it too long. Just some simple examples and just wanted to drive the point home. If anyone wants to reach out, you can do so via Kamalji or you can do so via us.
Right. Thank you so much, Neil. This has been really insightful presentation. So very first question, again, trying to put myself in investor shoes. What are the risks of special situations investing? And I just do not want you to address them theoretically, like practically you have given examples. In your journey of last 5 years, I'm sure your special situations, way of investing would have also evolved. Like I said, your last 3 years and 2 year numbers are good, but your since inception numbers are not that great. I'm sure you also went through the learning curve. So what is that learning curve? And hence, what are those, I would say, avoidable traps in special situations, which you want to talk about?
No, actually, our numbers are pretty good. is why it's the 5-year number is just about 15% KGAR post fees, still ahead of benchmark by a good bit, but it's 15% because when we started out investing, I did not know this business, and we didn't have any client money. I just transferred a couple of my stocks into the PMS account. I created my own PMS account so that we could do SEBI filings and so on to understand. And this was late 2017, approaching November, December. And this was the last legs of the bull market. And then everyone knows 2018, the trade war started and the small caps especially went down. So while I did not realize it, and I had not registered for PMS Bazaar or PMS AIF World at that time, I didn't know it's being counted as performance. So that's not actually our performance. Our actual performance is significantly better than the 5-year performance that people see. But yeah, coming back to your question, yes, we have been wrong in some cases in our special situations journey. But there is no different risk than doing any kind of investing. You're trying to buy a good business at a good price. Not all thesis will work out. You have to have a portfolio. So we have processes in place where we are a multi-cap approach. First of all, we don't want to do this only in small companies. So whatever we've done in a multi-cap approach. We've had a very balanced way of doing things. Even now, like we have Chola in the business. We have Chola in the portfolio. We have Piramal in the portfolio. We had Bajaj Finance for a while in the portfolio. So we have a lot of big businesses in the portfolio. That is one thing. Second is the number of stocks. You should not over concentrate 4 or 5 companies in the portfolio. You should always have things like, at least we generally own about 20 stocks in the portfolio. That gives you that room to err, basically. You get 2-3 things wrong, it doesn't matter. It doesn't, because the other things on the whole, if they do all right, you end up doing good.
Want to elaborate any example of a stock which went wrong and you then exited? What were the, how did you identify, that it is not working? Then you exited that at what loss?
Yeah.
So if that practical example you can give, that will kind of give more, I would say, understanding to the audience.
Yeah, there's a company called Thyrocare, which the promoter sold. And at that time, I thought it's an old promoter, and the growth was anyway slow. And the promoter was into things like good things like giving back to society and all those things. So I thought he was not too much interested in having that drive and hunger to grow the business in a big fashion. And then these guys come, Farm Easy guys come and take over the business. And I thought really this is going to change the growth profile of the business. What I failed to understand, and I think the entire street kind of failed to understand, that a lot of the margin that went up and a lot of the growth that came suddenly was because of COVID. And the minute COVID revenue started to go down, the entire thesis fell apart. The growth turned into degrowth. And we got in at, I think, 1300. 1300 was approximately the price of open offer. So we got in around that time. And we quickly exited around 1100. We realized at 1100 that we are wrong. And whenever I realize that I'm wrong, we like to kind of exit. No matter what price it is, we just take an exit. Now I think the stock is at 600.
So, our fund was called Special Situations and Technology Fund. And last 1 year has been tough, especially for the technology companies, because there the stock price actually has got derated, because obviously the valuations were high and now valuations have come off. So would you like to discuss experiences there with regards to certain examples in a portfolio?
Yeah, so I mean, if we were we were doing only special situations, our numbers would have been really amazing. But the tech part of the portfolio has kind of held back the performance. In hindsight, of course, we did technology. I still do feel technology will do good, but in hindsight, we should have booked profits a lot earlier. But we didn't, and we thought that we have a longer term view, so we continue to have that longer term view in things like intellect design and so on. So we'll hold on to our IT and tech basket. We are not adding to any of those right now, so it's become a very small part of the portfolio. All incremental money is going into special situations only. But yeah, whatever we buy, basically, we need to not get carried away. Is the learning from the tech investments of last year, is that even if you like tech, you have to make sure you are buying it at the right price. So that's a big learning for someone like me also. There's no harm in admitting we were not too much right on tech.
Sure. And you spoke about demerger as one of the ways to identify special situations. So many companies go through demergers. How do you identify which is the right opportunity?
Yeah, so then you have to actually go on and do a lot of scuttlebutt. I think scuttlebutt is something that has really helped us in our entire journey. You have to go on the ground and talk, not only to the promoter. Talking to the promoter, everyone does. You have to talk to the people surrounding him, take an opinion about the person and opinion about his team. Does he have the enough bandwidth that it requires? The quality of the guy. Talk about the auditors. You have to do. You have to do kind of financial due diligence also. So we have a system where we even check something like a GST payments of a company. Has the GST payment been delayed, for example? So all those things in terms of criminal track record, normal track record, financial track record. So you this is a normal, any fund that is in business, they do all these kind of checks and balances. So the simple checks and balances, so you have to do. You cannot just blindly buy a special situation. There were things like Talwarkar, for example, it went to zero. There was things like Syntex, which went to zero. So there are things which did not work. But you if you just do simple checks, these are red flags attached to this. So you just avoid them.
But still, within one particular special situations like demergers, there will be many good examples, many good companies with great managements. So you cannot obviously, add all of them in the portfolio. How will you identify which ones to be added in your portfolio?
Yeah. So yes, of course, but the valuation, right? So wherever in a demerger, if the valuation becomes compelling, you add those. Many times the demerger, like for example, the RT Industries demerger is happening right now, while the when the pharma business is being demerged, it's being demerged at a fair value already. It doesn't interest us as of right now, but yeah, if the price after demerger, if somebody comes and says that RT Pharma is too small for my fund, I bought it for RT Chemicals, for example, the chemical business, which is the larger business. So if any fund comes and says, okay, this pharma is too small as an entity, and I want to sell out, and if that causes a sell off in the price, and if the price becomes a no brainer kind of in terms of valuation, and the business is decent, the group is decent, then we go and buy. Valuation, of course, this what you asked, it all depends on the valuation of what you want to buy.
So in the overall process, in the context of your daily routine or maybe your team's process of working, you guys are only looking for special situations, or you do some kind of top-down approach in terms of first having some list of favorable sectors or unfavorable sectors, and then kind of get into various types of business models.
See, I have a view that in India, almost everything is going to grow. Whether I buy a fan company or a tile company or something like a curtain company or whatever it is, whatever it comes to mind, any product that comes to mind, India will produce more and consume more over the next 5 to 10 years. So I have no sector preferences in that sense. Of course, we like to not get too much involved with commodities. We like to have brands in the portfolio, because brands in the long run, you can protect your margins, you have your pricing power, you have a moat. All those things are there. So yeah, we want that, but sometimes something like a NMDC. NMDC is very interesting. It's a simple commodity business. The price was 100 rupees some time ago, and at that price, I had a conversation with the team, and they said the steel business is being demerged. So when we did the analysis and just compared the iron ore business and the steel business with the peer group, it came to the conclusion that if the price fell, by any chance, if the price fell to 80 rupees, the steel business was available free of cost. So when a business is available free of cost, it doesn't matter if it's a brand or it's a commodity, you have to buy it. Even the late genius, Mr. Junjunwala, he didn't shy away from buying Sesa Goa. He made huge amount of money in Sesa Goa. So we are very clear that, of course, we know what we want, but if there is value in something, we'll get into it.
So, special situations style of investing is something which, as you also acknowledged, is followed by a lesser number of players. People do follow, normal value investing, do follow normal growth investing, or maybe also follow momentum investing. But special situation style of investing has relatively less fund managers. Now, because obviously, fund managers like you are creating a lot of evidence in terms of how special situations is creating good amount of wealth. It is leading to obviously audience and investors getting too much educated about it, and they are also going to demand from larger companies to kind of bring out funds. And recently I know there are bigger names like Edelweiss and all who have raised larger corpuses into special situations investing, and that too in the AIF format. And likewise, there are other players also who are kind of come into a particular opportunity, then the kind of opportunity in terms of alpha creation maybe will diminish. What are your views in this regards? Because you cannot enter into every type of special situation, and beyond a point, if there are larger chasers for a particular value, then maybe the alpha will get spread amongst them. So in your view, how do you want to protect yourself, and what are the risks going ahead, that investors need to keep in mind, who will come and invest in your strategy seeing your past track record?
Yeah. So I think you were cracking a little bit, so I could not hear you correctly. But I hope I understood your question is what if more people come and do in terms of the funds, they come and do special situation. That's always, anything when something works, a lot of people will come. So yesterday only somebody told me in one of the groups I was in that we are not the only special situations fund in India today. There have been some other people who just launched special situations fund. So I don't know. India is a huge market. We have enough for everyone, and at the end of the day, you need to. I mean, you need to work hard. You need to work really, really hard. I mean, we are. You won't believe my team and I. We do actual analyst calls at 1 a.m. at night. Now you need to be committed like that. Now, just to be honest with you, if I were to hire somebody and tell him to go run a special situations fund and burn the midnight oil, no one going to do that. They all going to want is Saturday off and Sunday off. We don't do Saturday, Sunday off. No chance. So it the number of hours you spend on doing the work, So I am not too much bothered. And if it is, then we'll find a way to, we'll work harder.
But special situation style of investing, does it get limited by the number of players or the kind of AUM, or it has no linkages to that?
It has. So, so you have to be very careful about how much money you want to manage. So even with our fund today, we have crossed 500 crores in AUM. We are going to stop at 1500 crores. We're not going to take more money beyond that, and then we will just focus on performance. So you cannot do a special situation fund raising large amounts of money. It's not going to happen.
Can you explain this with example?
So a lot of these special situations that created a lot of wealth, if you had, let's say, 10,000 crores to do and deploy here, there is not enough liquidity. So, okay, maybe you can go and buy Ambuja cement and make good money. We did that in Ambuja. We made good money there. But for example, in anything in the mid cap, small cap, you can't do. So then, as a fund, you cannot operate properly. There is no balance. So as a balance, you need a special situations fund in India. In today's market, of course, the market in India will become bigger. But currently, I am of the opinion that 1500 crores, somebody should just stop accepting more money.
Right. So with regards to India's economy, as you mentioned, that these are the best times, one should not, miss out on these times in terms of opportunities, and there are kind of wealth creation opportunities in almost all sectors, all types of businesses. So can you please, would you want to elaborate more with data and maybe, your projections of India's economy and in terms of various sector participating? Obviously, this being the 75th year of India's independence, and since all of us are talking about India has already reached number 5 in terms of GDP, right? But the thing is, all of us want to kind of understand it more objectively from the perspective of possibilities of wealth creation in this decade. So, you are on the other side of money management. Obviously, as investors, as advisors, we're always hopeful and wishful. But what is the practical guidance that you want to give to the audience? And what are the data points that you want to support your argument with?
So I'm not saying something which this is going to happen for the first time. India had 30% of the world GDP if you go back in history. Before the Mughals came and before the British came and destroyed India, India was known as the golden bird. We are just reverting back to mean. This is not something which is magical that is happening. This is just what is supposed to happen. India as a land, India as a people, they are going back to where they belonged all along. So in terms of just reverting to mean, that is one. And secondly, everything that you see in India, let's say the per capita GDP is 2,500, it's just too small. If the base is too small, I read a report somewhere that in the next few years, 80 airports are going to be set up in India. 80 airports. Now, it's a mind-boggling opportunity, in my opinion, and we should be fearless in this situation. This is not going to appear again. And it should not be a situation that in 2050, when we become a developed economy, more or less, and you come back and say, I knew all this, but for whatever reason, I was owning FD and I had bonds, and I did not participate in India because my neighbor said the market is going to crash, for example. So you have to remain fully invested, and you have to have that conviction. And after having the conviction, there will be blips. We are not going to avoid the blips. There will be a time where market falls 20%. It'll happen, but we have to remain steadfast. There is no other alternative. So we have to believe in the India story right now.
Sure. What are your views with regards to auto sector, especially with the EV coming, and everyone talking about it being a big opportunity, big disruption, and maybe big special situation happening in the industry. So how do you see auto sector maybe going ahead?
So we don't look at any sector normally. We I know everything will do good, but what we want to do after knowing that is we want to pick up good ideas in that. So for example, Motherson did a demerger recently where they demerged their wiring harness business. Now, for whatever reason, it did not go to the price I was hoping. I was hoping we buy it at 40 rupees, but it didn't go to 40. It listed at 80, fell till 55 after post demerger selling, and it reversed from 55 and went back to, I don't know, it's maybe 90 now. So we want to do things like this in auto, for example. We want to get involved with companies which are growing and available at a good price. So of course, EV is a no-brainer. Anybody can figure out EV is a no-brainer, but EV, if you go and simply buy an expensive idea in EV space, you may not make money because the technology here keeps changing. And as the tech keeps becoming better rather, a lot of people will become obsolete. A lot of new people will come into the picture. So I would rather just focus on events where you have a demerger or a delisting or something like that and invest from that point of view.
Sure. So to everyone, who is attending this webinar, and most of you have been asking, questions, which I am trying to cover within 1 hour, because we have just last 5 minutes to go. In case you miss out your questions, I would urge you to kind of book calls with us. We, represent PMS AIF World, which is one of the most trusted platforms and is helping various HNI and ultra HNI clients all over India and abroad to make well-informed investments in PMS and AIF products. Negen Capital PMS, which is special situations focused portfolio, is one of them. And you're most welcome to, connect with us. We are very highly specialized in, providing such kind of client investment services. Moving on to the next question, again, trying to put myself in investor's shoe. You mentioned, Neil, that had you not invested into technology stocks, your returns would have been even higher. So can you please again put this in perspective in terms of some numbers, and what percentage of your portfolio today has an element of special situations and an element of technology being an argument for you to invest into it?
So I believe as of right now, technology as a part of the portfolio is less than 15%. We've actually just concentrated totally on special situations recently. We own some ideas like Nika. We own something like a Policy Bazaar. We own something like a Intellect, Design, RateGain. These 4 or 5 stocks we own. I really like them. I do believe they will keep growing, but I think we got the entry points wrong in hindsight, of course. But in the long run, I feel they should come good.
So what is the kind of attribution to the I would say such loss making bets that you kind of want to kind of talk about?
Yeah, so it was basically getting carried away with the growth numbers and not paying too much attention on my core bread and butter, which is the valuation aspect of it, thinking that growth will take care of valuation. But I think going forward, we should all always look at also valuation. Valuation is very important. It has to be a marriage between valuation and growth.
So in future, any of these new age company which gets listed, obviously, we know that all these new age businesses which are especially tech backed, like today, in case an example, maybe Byju's and many other become in future. So you would not want to invest in any of these businesses in future, given their valuation problems.
Unless they come at a very reasonable valuation, whereby you say that the PE ratio of the business is, let's say, 20, and they are growing at 30%, then that's where you make money. So I'm not going to be buying at 20 times revenue, that's for sure. It has to be 20 times profit. So we even fund managers, even investors, everybody goes through periods where they have to learn, evolve. So I think I've gone through that period myself, and going forward, we are only focusing on this value investing via special situation.
Sure. You spoke about demergers and change in management, as two, I would say, major elements or maybe traits in your special situation style of investing. Are there any other, I would say, styles within special situations, or maybe, I would say, corporate actions, which kind of make you realize that there is a special situation?
There are lots which are not heard of. Like I already mentioned in the presentation, things like partly paid up shares are very interesting way of making money. Rights issues, you can you can over apply for, and you can get more shares of people who have not applied for it. For example, warrants that are listed are very interesting also. So there are other things in special situation, but they are highly complicated. So we don't talk about it in public too much. The easier ones to understand and explain are the delistings, promoters changing, and demergers, and sometimes reverse mergers.
So my question pertain to basically your current portfolio. So your portfolio in terms of allocation to various corporate actions in terms of special situations is particularly trying to chase change in management and demergers, or any other actions also.
Yeah, so what we're trying to do is basically value investing. So many times in a bearish phase of the market where everything comes down, you can even do normal value investing. There is no hard and fast rule that you have to do only in special situation. So when the markets fell earlier this year, we acquired businesses like Sapphire Foods, for example. Now Sapphire Food is in the QSR space. There is no actual special situation there, but it fell to 900 rupees, and at 900 rupees, it was in single digit EBITDA. If you go extrapolate, a couple of years forward. So I thought, I'm pretty sure the QSR industry is going to grow 20%. I'm pretty sure the good players will grow 25 to 30%. So anything that is in single digits, because of the markets being bad, everything is down. So we do normal value investing in bear markets. What I'm trying to say.
Sure. So you took example of Aarti Industries. So again, I will take you back to that example. Does Aarti Industries in terms of value investing not look you interesting because stock price has fallen, and if you see last 1 year growth in terms of its profitability and revenue growth, both numbers are good, but the stock price growth is negative in double digits, and it belongs to a good sector. So in that regards, why will you reject it from your point of view in terms of in terms of value investing?
So I don't think the growth will be massive in the sense that it's going to grow 30%. It's going to have very normalized growth, and the valuation, even if you see FY25 valuation, is trading at something like 20 times. So it's not cheap, but yes, if it became cheap, we'll look at it. So when we want to do something in the special situations horizon, we want something like a single digit kind of valuation, or starting in the double digit, like 10x, 12x kind of thing. Like for example, Piramal Pharma, when that company will relist, and if it relists around 12x EBITDA, I'm much better off buying Piramal Pharma than RT Pharma at something like 25x right now. So it makes no sense. So valuations determine what we do. So if RT Pharma after demerger, if some funds decide to sell it and it becomes very cheap, then yeah, it will become a very good investment.
So
But right now it's at fair value. It's not cheap any at this price.
again, to everyone who is attending or maybe will watch this video, this is just a disclaimer that all these names that we are discussing are just for education purposes, and we are just trying to use them, quote them for an example. If you get into any of these names, please do not construe any of the things discussed as an advice. Take your own judgment, analyze yourself, or maybe consult your advisor. Moving on to next question. Again, this is the last question of this evening. We are trying to understand the special situation style of investing. When you entered into CG Power, that is one very interesting special situation which I think was easy to identify because of a change in management, and it was very clearly visible. But stock price actually moved, I think, more than 20 times from its lowest point. So how did you decide exit? Or you may want to take any other example. We want to understand that why and how will you exit, because at the end of the day, if you have identified a good stock and you hold it for 10, 15, 20 times growth, obviously then it will generate great returns. But if you exit at 2, 3, 4 times of growth, you may feel that obviously you did not do that well. So again, these are also part of learnings that you may have had over last 5 years. So we want you to share with us all those learnings as well.
So it's not easy to figure out the exit in these kind of situations. Uh, for example, in something like a green panel, we bought at about 30 rupees, we exited at 350. It went to 600 after that. I'm not claiming that I held till 600. In something like a RT Surfactants, which is another RT group demerger which happened some time ago, it delisted and fell to 222. We were the first buyers at 222, and within a month it went to 509. We exited at 509, and then it went to 1800 within the next 3 months. Where we could have made a 9 bagger, we made only a 2x. So many times we get it wrong. There is no way to figure out the right kind of exit opportunity here. You have to just take a call on valuation. And for example, we bought Adani Power, Adani Green for that matter, at 40 rupees, and we exited at 60 rupees, thinking that acha ho gaya. From 60 it went above 1000. So I don't know what view we have on Adani, but we were the first people to buy even Adani Gas. Adani Gas at 85 rupees, I said no, I want it at 65 rupees, and for whatever reason we could not do what I wanted to do. But again, Adani Gas went absolute. Okay, let's not have a view on this, but yeah, it's not impossible to kind of figure out the exact entry and exit. Is basically need to have the right philosophy. Some things will get absolutely right, some things will not get right. On the whole, if you make a nice portfolio and have a longer term outlook to things, on the whole we end up doing good.
Or I will just take one more question, and this is the last question, because there are around 300 people attending us. So I am trying to cover whatever is practical question which any client would have in their mind. So from the perspective of investors, the very first aspect that comes to everybody's mind when he's attracted to a particular product is the risk. On the chat also you can see most questions do not pertain to returns, they pertain to trying to analyze the risk. And when you also quoted the example of Asian Paints and stocks likewise, which are highly priced, but despite their high valuations, they are perceived as low risk. And that is where some of those, I would say, large cap biased, consistent compounding, focused portfolio management services, they attract thousands of crores of AUM. Because at the end of the day, all these investors are feeling more comfortable investing in some of those strategies. On the other side, your strategy is actually throwing lower valuations and higher returns. But despite that, it becomes difficult for an investor to take a call. Maybe it is a lack of knowledge in terms of trying to relate with some of these names like you're talking about. So how to address this particular concern, and is this concern a valid concern, or it is actually a lack of knowledge? If you have faced some of these clients and you have converted some of these clients to your strategy, And obviously after that, clients have learned from their experience, because obviously when you succeed in doing something, that becomes the biggest learning. So I want you to spend maybe last 4 or 5 minutes explaining this part of your success.
Yeah. So, we all know about great investors of the past. Let's take someone like a Warren Buffett or Peter Lynch, Charlie Munger. Warren Buffett would rather die than buy Asian Paints right now. I can say that without, I've never met him, but I can fairly confidently say that. These guys have made money buying companies and watch them grow over time. So even someone like the late Mr. Jhunjhunwala, when he bought Crisil and when he bought Titan, no one knew them. He bought it at a very peanuts kind of valuation and he saw it grow. So it's a big difference to not, I mean, in my opinion, investors should not do this on their own. They should do it via some kind of a fund structure where they, because this is a little highly complicated kind of looking at things, but it's not more risky. Why is it more risky? I mean, it's just we are waiting for the value to, I mean, to get unlocked in terms of a trigger. It's just as a normal value investing. What is wrong in a company like Chola today? Nothing. What's wrong in a company like Piramal? Nothing. What's wrong in any of the businesses that we own? Nothing is wrong. There's no extra risk. It's just that none of the great investors in history would have gone and bought a company which is expensive. They would have, if you told Warren Buffett, okay, you're 25 years of age today, here, take $1 million, go buy things. You think he's going to go and buy Asian Paints? There is no chance. There's absolutely no chance. Warren Buffett, Peter Lynch, R.K. Dawani, even the late Jhunjhunwala, no chance they are going to do anything like that. So why should we?
Sure. Thank you so much, for this elaborate answer. I'm sure, the audience out here learned something new, something unique. And obviously, this reinforces the confidence about India's economy and equity as an asset class overall. Thank you everyone for joining us today. You're most welcome to book your appointments with us. We'll be happy to serve you. Thank you, Neil, for your time today, and have a nice weekend, everyone. Thank you.
Take care, everyone. Thank you for joining us. If you have any questions, you can reach out. Take care. Bye.